Hey, hello investors and future investors. Welcome to the channel. For today's video, I'll be showing you a simple option strategy that can be used in order for you to make weekly income. I'm going to go ahead and show you how you could use this option strategy, particularly if you are trading with a small account. Now, if you are new to options trading or you're trying to use options in order to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'll be giving you a step-by-step walkthrough of a simple option strategy that can be used if you're trading with a micro account. That's right. If you do have an account with just a couple of $100s, this option strategy is going to work particularly well in order to help you grow that account consistently over time. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. For today's video, we're going to be showcasing the SPDR ETF, and that ticker is going to be SPY. So let's go ahead right now, and we're going to go ahead and go to Trade SPY options down to the bottom here in order for us to go ahead and open up the options chain. Now, all the information down here in its entirety is what's known as the option chain. And what the option chain does is that it gives us enough information in order for us to make an informed decision. Now, right before I go ahead and jump into these option strategies, I want you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for yours. The second favor you're going to want to do yourself is that always make sure you have an exit strategy before entering to any options contract. That way, if the trade do decide to go tits up, then at least you know how to get out of the trade. And lastly, these videos are merely for entertainment and educational purposes only. Now, for this option strategy, what we're going to be doing, we're going to be capitalizing on the upward movement of the market. Market is at all-time highs, and SPY has hit another all-time high, and the price is around 682. So what we're going to be doing, we're going to be implementing a bullish option strategy because we do not want to bet against the market. Now, for that option strategy, we're going to go ahead to sell. We're going to go ahead to put, and now we're going to choose the expiration date. For the purposes of this video, we're going to be doing weekly expiration date because the whole purpose of this video is to show you how to make weekly income. So we're going to be choosing October 31st, which gives us about 5 days to expiration. Let's go ahead. We're going to select that. Now, what you want to do, I'm going to go ahead and I'm going to select my strike price. The strike price I'm going to be going with. Now, if you are new to options, what you could do, the rule of thumb is that you're going to go ahead and use this column right here, which is known as the chance of profitability. You're going to go ahead and start off with an 80% chance. So as you can see here, there's an 80% chance. The 80% chance is going to coincide with the strike price of 667. Now, that is a basis of how I would choose my strike price. Now, there's another way in which you could choose your strike price, and that is to go ahead and get the expected move. Now, I have made a video about the expected move, so I'm going to give you a brief outlook of what that means. So if you are new to options, you're simply going to open up a browser. You're going to go ahead and type in SPY expected move, and any graph is going to pop up. Once that opens up, then it's going to tell you where the expected move is going to be by this particular date right here. Now, I've already gone ahead and looked at the expected move for SPY expiring October 31st, and that's going to be 688. So by choosing the 667 price, I went ahead and be a bit more conservative. Now, because this is going to be a sell option strategy, it's going to be paying us. Now, the amount it's going to be paying us is going to be $2.02. $2.02 in the real world is going to work out to be $202. And that's simply because each option contract does contain 100 shares. So we're simply going to multiply the 2.02 by 100, and that's going to give us $200. Now, this is the first leg of this option strategy. The reason why most of you would not be able to do this part of the option strategy is because this option strategy is known as the cash secured put. With the cash secured put, you will be required to leave a collateral. The collateral in this case is going to be whatever your strike price is multiplied by 100. Remember, each option contract does contain 100 shares. So if you were to do this cash secured put, it would cost you $66,700. That's going to be 667 multiplied by 100 shares. So most of you guys do not have this. So what we're going to do, we still want to go ahead and implement this bullish option strategy to capitalize on the market's momentum. So what we're going to do, we're going to make a slight tweak to this bullish option strategy, and we're going to go ahead, we're going to change the parameters from sell, we're going to go to buy. We will be maintaining the put option, and we're going to be maintaining our exact same strike date. The next step we're going to do, we're going to go ahead and choose a strike price right below the previous strike price we chose. So that's going to give us the 666 strike price right here. Let's go ahead. We're going to select that. Now, this is the second leg of this option strategy. This option strategy is going to be known as the put credit spread. The put credit spread is a bullish option strategy that can be used right now to capitalize on the market's momentum. Now, for this second leg right here, this second leg is going to represent a buy option. So now we're going to have to pay. The amount we're going to have to pay is going to be $1.88 multiplied by 100 shares is going to be $188. Now, this is also known as an income generating option strategy. So the income you will be getting is going to be the difference between your two prices right here. Now, this option strategy, like I mentioned, is going to work out perfectly if you're trading with a small account. And the reason for that is because the barrier to entry is extremely low. Let's go ahead, let's hit continue. Let's go review order. Now, in order for you to do this option strategy, all you need to have in your account is just about $100. Now, the $100 is going to represent your collateral. Remember, the first leg of this option strategy, you would need to have $66,700. By making that slight adjustment, your collateral has now gone down to just $100. Now, how do you come up with the collateral of $100? Well, that's quite simple. Your collateral is always going to be the difference between your spreads. The price of your spreads right here is going to be 667 and 666. The difference between this is going to be $1. Once again, we are dealing with options contracts. So you're going to multiply your $1 by 100, and that's going to give you $100. Now, like I mentioned, this option strategy is an income generating option strategy. So once you go ahead and you decide to implement this option strategy, you're going to be paid. The amount you're going to be paid is going to be $15.92. Let's round it up to $16. Now, that money is going to be yours to keep no matter how this trade goes. Now, there's a couple ways in which you could make more money. The number one way in which you could make more money is going to be to scale. And by scale, I mean you could go ahead right here and you could increase your contracts. Instead of doing one like I did for this example, you could go ahead and do 2, 3, or 4. Always do whatever your portfolio can afford. Now, the other way you could go ahead and make more money is to increase your legs or your width of your spread. So I'm going to show you how to do that. So let's go ahead. We're going to deselect this. So instead of going to the 666, we're going to go one down to the 665. Let's go ahead. We're going to select that. So now we have changed the parameters once again, and I just need to go ahead and refresh this because it still says 15. So let's go ahead and go back, and we're going to resubmit, and there you go, it's updated now. So the new amount of money we'll be getting is going to be $30. Now, it does look like it's almost twice as much, but what you actually went ahead and did is that you got more money, but you also reduced your risk. I'm going to show you how you reduced your risk. So in the previous example, if the share price were to go down, it's a lot easier to get to 666 and 667. By going one more down, it's a lot harder now to go from 667 to 666 to 665. So by increasing your spreads, you're increasing your chance of you winning this trade. Now, with the decreased risk that you have achieved, you will have to pay more in order for you to leave a collateral. So now your collateral has gone up to $200. And once again, the collateral is going to be representative of your spreads. So the difference between 667 and 665 is going to be $2 multiplied by 100 shares, and that's going to give you $200. So that is the two ways in which you could go ahead and you could scale up with the put credit spread. Now let's go ahead and we're going to go back to our previous example of 666, and I'm going to show you how these trades could go. So ideally, what you want come expiration date or before of October 31st, what you want is that you want this current share price here of 681, you want it to stay above the 667. Once that happens, then you're going to get to keep your collateral of $100. You're going to get to keep your $30 of premium that you receive. Well, let me go back because this needs to be refreshed once again because that should say $16. Let's go review. Good. So you're going to get to keep this $16. That's going to be yours to keep no matter how the trade goes. And your collateral of $100 is going to be released back to you. Once that happens, then you have a choice. You could choose to rinse this option strategy, repeat this option strategy, and go ahead and keep on locking in investment gains. Now, the other way this trade could go, come again, October 31st, which is our expiration date. If this share price right now happens to drop below the last leg, which is the 666 price here, well, once again, you're going to get to keep the premium that you receive, which is $16. However, you're going to lose your collateral of $100. Now, your total loss is not going to be the entirety of the $100. Your total loss is going to be the difference between your collateral and what you received. So in this case, it's going to be $100 here minus your collateral of $16. So your total loss is going to be $84. Hence, you need to be very careful if you're going to go ahead and scale this option strategy. Now, that is one option strategy that can be used to capitalize on the market's bullish momentum. If you do also want to go ahead and scale this option strategy, what you can do, instead of going ahead and get multiple contracts here or increasing your spreads right here, what you can do is to go ahead and go out a couple of weeks. So your first expiration date for one contract could be October 31st, and your next one, you're going to go ahead, choose 14 days. Let's see it like right here, and that's going to be your next one. And then the other one is going to be 21 days, and so on and so forth. So every week you have expirations closing, and you just keep locking in your gains. Now, the chance of profit we chose was 80%. That means there's also a 20% chance that this trade is going to go against you. So remember, always do your own due diligence and do not invest any amount of money that you're not willing to lose. So there you have it, investors and future investors. If you guys have any question about how to implement the put credit spread in order for you to assist to grow a small accounts portfolio, then just let me know in the comments below. Now, for those of you that made it to the end of this video, you guys are the real investors and future investors. If you have not already, now would be the perfect opportunity for you to go ahead and like the video, subscribe to the channel. Most importantly, go ahead and hit that notification bell to get an alert when I post these videos. I do post pretty often. You don't want to miss these videos. In these videos, I specialize on helping you grow a small account portfolio. Now, lastly, before you go, I do make all these videos and produce all this free content in order for me to help as much people as I can. So if there's anyone out there you know that's struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. Together, let's help as many as we can start generating income from options trading. Now, until the next video, keep pushing your investments.